Hello everyone, Anthony Crudele here for Futures Radio at CME Group's Global Command Center. Today I'll be sitting down with CME Group's senior economist, Erik Norland. We're going to be talking about fixed income, equities, tomorrow's retail sales number, which is really going to be, I think, very important. So I'm curious to see what Erik has to say about that. We're going to talk about the recent non-farm payrolls, and of course, we're going to talk about the Fed. So Erik, welcome to the show.
Thank you very much.
So let's talk about today a little bit. We saw since non-farm payrolls, we've had a decent sell-off on the long end, 30-year, and then we've had 10-year fall off a little bit, and now we're seeing equities follow suit a little bit today. What do you think about that, and does any of that concern you?
Well, I wouldn't say it concerns me, but what I do think is happening is that the market's reevaluating its initial interpretation of Friday's employment report. When the report came out on Friday, we had a somewhat weak report. We had 223,000 new jobs created, which was 5,000 below consensus. But there was also a negative revision of the previous 2 months that totaled about 39,000 jobs. So the total miss, if you will, was 44,000 jobs. In addition to that, average hourly earnings failed to advance at the pace that the market anticipated. Economists had thought they would grow at 2.3% year on year. They in fact came in at 2.2% year on year. So the initial response to that was very positive for bonds and for equities. They both popped on that news with the idea that a fairly soft report might cause the Fed to delay an eventual rate increase. But now I think the market's reevaluating a little bit, and I think the reason for that is that the jobs number wasn't terrible. It was not a home run. It wasn't even a triple, but the job market's been hitting a lot of singles and a lot of doubles recently, and that's adding up. And so if you look at the total number of new jobs created over the past year, the number of people working has expanded by about 2.1%, and the average income has grown per person by 2.2%. So when you add all that up, the total amount of income flowing to labor is increased by 4.3% year on year. And that's a very, very robust pace of growth that should support retail sales, housing construction, business investment, and also government tax revenues, not just at the federal level, but also at the state and local levels.
So ultimately, that number, we're going to look at it and say it was kind of like in that sweet spot where it keeps everybody a little bit guessing. Is that kind of what you're saying? No, everyone is kind of like, we're moving on to the next number again. Just seems like we're always, moving on to the next data point. So we're going to talk about retail sales, which is tomorrow morning.
Right.
Now, I think this is going to be an important number. What do you think?
I agree with you. It's going to be tremendously important, and I think there's two reasons for that. First, we have a very data-dependent Fed that's looking at every single release coming in, and that makes every single release very, very important. And then secondly, when oil prices collapsed, we saw a tremendous drop in the price of gasoline. And so the immediate impact on retail sales, ironically, was very negative because people spent a lot less money at gasoline stations. So we saw really weak numbers for December, January, and February. It wasn't until March that we started to see the first signs of a rebound. And so April is really the second test. Are consumers going out and spending that money that they're no longer having to spend on gasoline on other products or not? And we'll know the answer to that, or at least 1 month's worth of the answer to that at 8:30 tomorrow morning on the East Coast.
So I wrote this question I want to ask you, and I wrote it, and I'm going to read it specifically from this because I think the way I wrote it is very important. Does the Fed start to get a bit more concerned if retail sales are weaker than expected, given their transitory stance? Because, on this last FOMC number when I was trading, I know that the transitory word was really, important. Or do you think that they are currently focusing more on the inflation part of their dual mandate?
Well, let's first talk about the dual mandate. The dual mandate is very, very unusual in the world of central banks. Most central banks, like the European Central Bank or the Bank of England or the Reserve Bank of New Zealand, for example, they have an inflation target, and they're meant to hold inflation kind of at or perhaps slightly below their upper target. The Federal Reserve actually does not have an explicit inflation target, but we think it's around 2%. And that's sort of what they indicate in their discourse. But in addition to that, they also have a mandate to produce low unemployment and economic growth. And so I think right now the Fed is not particularly concerned about inflation. And the reason for that is that headline inflation is obviously extremely low. The CPI index is essentially flat year on year. The Fed's preferred measure of inflation, which is called the PCE deflator, is essentially up 0.3% year on year. And when you strip out food and energy, which are the more volatile components, inflation's still very low. On core CPI, it's around 1.8%, which is a little bit of a concern. But what the Fed really likes to look at is the core PCE. And that is up only 1.3% year on year. And so this has left them to focus on numbers that indicate growth rather than inflation, including retail sales, and sort of amplifies their importance.
Let's talk about Europe a little bit. Okay, we've had this large boom sell-off. Now, do you think it's impacting the U.S., or do you think that there's more to the U.S. move based on our own fundamentals?
Well, I think it's some of both, but let's first of all talk about how deeply intertwined these two markets are. It's a global market for capital. And so when interest rates become extremely low in one part of the world, like they did in Europe, it causes investors there to look elsewhere for yield. And so when German yields got down as low as 10 or 15 basis points on the 10-year, and when Swiss yields actually went negative on the 10-year, and also in addition to that, it's also worth mentioning that in Italy, for example, which has a triple B plus rated bonds, their yields were as much as 50 or 60 basis points below 10-year treasuries. There were a lot of Europeans looking to this side of the Atlantic and saying, look, we can use swaps and futures to pick up a very, very nice carry, essentially by going long U.S. fixed income and short Germany. And so when that trade started reversing and the German Bund sold off, it also enabled the Treasury to sell off at the same time. Now, that doesn't mean there weren't other factors that influenced. Europe and the U.S. also have their own fundamentals. And what we're seeing in both economies is a rebound. Europe, as we know, has been very weak for a long time, but they're finally putting their house back in order. We're starting to see a pickup in their economic growth rate. It's somewhat halting and inconsistent. Whereas in the U.S., we had a very weak first quarter, but the indications so far for the second quarter are for much more robust activity. And that also contributed to the Treasury sell-off.
So do you think that the markets, the U.S. markets in particularly, 10-year, 30-year, do you think that they're indicating possibly that the market is looking for a rate cut sooner than later?
Well, I think that the
Or
market...
rate hike, I should say, not rate cut again.
Yeah, well, I think that the market is definitely anticipating some sort of a rate move. It's really a question more of when than if. And so what we've seen is we've seen an enormous revision to expectations so far this year. If you looked in, say, December, the market was expecting a fairly high probability that the Fed might go as soon as June. Now the market's not really fully pricing a rate hike until the end of the year. But if we do see a rebound in second or third quarter economic data, that expectation could be pulled forward again, maybe to more like October or September, or possibly even sooner, depending on the strength of that rebound.
So I guess the question would be, if the retail sales number is soft, and let's just say we continue to see data stay a little bit weak, kind of that transitory statement is kind of out the window, correct? So then what do you think then that happens to rates then? Or the Fed's decision to potentially raise rates? Well,
if retail sales remains weak, I think that would really push off the Fed's potential rate increase. I think if we see a weakness in the labor market or in consumer spending, I think that would pretty much seal the deal and push the Fed rate increase off until we see an improvement in those indicators, whenever it is.
So that's why that number, I think, is just so important. So I want to talk a little bit about the relationship between the U.S. Treasuries and U.S. equities. Meaning, we talked about this before we came on the show a little bit, selling off together. Mm-hmm. I've been saying for a while that I really feel that's when you just start seeing things really get volatile. Or me being a short-term day trader, when I wake up this morning and I see that the 10-year continues to go lower, the 30-year continues to go lower, and I see equities, S&P down 20 points, that's when I think this fire starts, and you can start seeing this pullback in equities. Do you think that they're going to correlate moving forward? We talked a little bit about that correlation, a little bit on the short term, but let's maybe take it a little bit farther on the longer term.
Sure. I think that the U.S. Treasuries and the U.S. equity market have a very, very long history together, going back almost to the beginning of the country. And so they've had a very volatile relationship. at times, and there's really two different correlation patterns that exist at different times. And I think that those two correlation patterns will continue to exist going forward. But the problem is those two correlation patterns are opposite one another, so they can't exist simultaneously. So essentially there are periods in which bonds and equities become positively correlated. And I think it's important to point out when I say that, when I mean bond prices rather than yields, become positively correlated to equity prices. And so they tend to be positively correlated when the market is afraid of things like deflation, recession, or economic collapse, or financial panic. In that case, equities will sell off and it will create a flight to quality that will cause bonds to rally. So they become negatively correlated, I should say, rather than positively correlated. Now there is another regime, which is a regime we've seen in the last few days, in which they become positively correlated. And that's a regime in which the market's main fear is either inflation or an incipient Fed rate hike. And so the fear now is that the Fed might withdraw some of that liquidity, which in turn would send bond prices downward, and could also send equity prices downward simultaneously. But I think as you hint at in your question, there is a pain point at which the equity market might start selling off so much that the correlation abruptly reverses and equities sell off and bond prices start to rally. And so it's a very, very volatile relationship between the two.
Yeah, I mean, and now we talked about the downside of maybe the retail sales number being a little bit soft, or not necessarily downside, but we talked about what we think could happen. Now, what happens if that number is really good? What do you think that brings?
Well, I think it brings an immediate bond sell-off, and it may also
Across the board, so 5s, 10s. Do you think 5s and 10s maybe a little bit more exaggerated?
Possibly. That's sort of the bulge in the curve. So when things move out, the 30-year tends to be a little stable because the time horizon is so long. On the other hand, the very short end will sell off probably if we get a very strong retail sales number. But yeah, I think that there's sort of a limit, the pace at which the Fed is likely to actually raise rates. They probably, the market will never expect them to do more than 25 basis points per meeting, and we're still very far from that expectation. I think it leaves 5s and 10s as the most exposed.
So going forward, let's go beyond the retail sales. What other upcoming numbers do you think that we should be really focusing on? I know we talked about, obviously retail sales being important right now, but let's just say that number, you never know. Sometimes these things, it could come in and it could be a total dud. Maybe it comes in right in line. It's another one of those unemployment numbers where we say it's kind of right in that sweet spot. What moving forward do you think we should be watching for then?
Well, so I think that there are a number of other indicators that will be very important. I think that housing activity could be a source of interest. We get a bunch of mid-month housing data. The housing recovery has been very halting, as you know, but I think that there's a lot of potential for growth in housing for a whole variety of reasons, including extremely low mortgage rates, growing consumer incomes, as well as very low inventories and vacancy rates. So there's a potential for upside surprises, as well as, of course, downside surprises to the housing data. And there's a whole variety of other numbers coming out. We have CPI, of course, mid-month. We've seen some rebound in gasoline prices recently. So it'll be interesting to see if that inflation rate starts ticking back northward. And if it does, that might cause some doubts as to whether or not the Fed will keep policy easy. And then, of course, we have the employment data, which comes out every week, like initial and continuing claims. And then early next month, of course, the new employment numbers. And those will be a big center of focus.
Well, Eric, I really appreciate you taking time out of your day to join me here. You really gave us some great insight, and I really appreciate you.
Thank you so much for having me.
All right, everyone. Remember, go to our website, eminiexchange.com. Sign up for Futures Radio updates so you'll know who our guests are and what topics we will be discussing. Be sure to follow me on Twitter @Anthony Crudele and use the hashtag Futures Radio for your questions or your comments. Now, before I let you go, I want you to remember the 3 words that I say every day before I begin to trade on my machine: preparation, anticipation, execution. Thank you, everyone. Take care and trade well.